Hello, I am Precious Swain Peaks, owner of Anointed for Prosperity Bookkeeping and more. And today's broadcast focuses on parents, grandparents, adopted parents, anyone with dependents. Normally, I do this class live. Today, I'm going to go ahead and record only because I want to expand the reach of this information. The first thing we're going to talk about is the horrid rumor that you can only claim 3 children. That is a miscommunication. It is not true. You can claim all of your children that you gave birth to that live in your house and you take care of them. You can also claim your parents if you take care of them, and they do not have to live in your home, but you have to provide 50% or greater of their support. Or if you have adopted, you are definitely able to claim them. Where the miscommunication comes in with the 3 is that only 3 of them will get earned income tax credit. So it is very important to know the difference. You can claim all of your children. We're going to talk very briefly about why you should claim all of your children. If the stimulus payments and the advanced child tax credit payments did not teach you why you should, we're going to walk through a few reasons why you should claim all of your children. But it's also to dispel the horrid rumor. It is not true that you can only claim 3. You will only get earned income tax credit for 3. So let's move forward. The first thing that we're going to talk about very quickly is the child and dependent care credit information. In order to claim child and dependent care credit, you had to have paid expenses for the care of a qualified individual to enable yourself, and if you're married filing jointly, your spouse, to work or actively look for work. You and or your spouse had to have lived in the United States for more than half of the year to qualify this credit. If you are in the military, there are special rules, and definitely your tax professional will be able to assist you in that area. But if you are not military, you had to have lived in the United States for more than half of a year. So this credit is available to dependents under the age of 13 unless they have some form of special need. So if they are incapable of self-care and they live with you for more than half of the year, they are eligible for this credit. If they are under 13 and go to daycare, after school care, Boys and Girls Club, they are eligible for this credit. Okay. This credit is to help the people who work to be able to afford the daycare that they have to pay for in order to go. So, even if it's no limitation on the amount of children, so if you have 5 stair step children, all under 13, 12, 11, 10, 9, 8, or even lower, all of them could go to after school care, could go to daycare, and you would still be able to utilize this credit. The other thing that this credit applies to is if you pay a babysitter. So if they're not in a formal daycare or after school program, but you pay a babysitter to either come to your home or to take your children to their home, then you can still claim this credit, but the babysitter must provide name, address, phone number, social security number. There's no if, ands, or buts, and there are no exceptions. This information must be on the tax return to claim this credit if you are using a babysitter. Babysitters that do not qualify: grandparents, siblings. So you may pay one of the older children to watch the younger children. You just cannot claim it on your taxes. Okay? So this is one of the reasons to claim all of your children, because just because they don't all qualify for earned income tax credit, there are other credits available for the other dependents. So then we're going to take a look at the other dependent credit, because you can get credit for other dependents. Well, what qualifies as an other dependent? Dependents of any age, including those who are 18 or older. So if your child still happens to live at home at 18, no, they're not going to get earned income credit. No, they're not going to get child tax credit. Definitely, unless they have a special need, they won't get dependent care credit. But if you are still supplying all of their support and they still live with you, then the maximum credit per dependent in that situation is $500. It is not a refundable credit. So you're not going to get a check for $500 for each of your dependents. But what will happen is it will bring down your taxable income by $500 per dependent, which could possibly increase your refund amount. There is a max for this. Um, if it is a single head of household taxpayer, they cannot make more than 200,000. If they are a married couple, they cannot make more than 400,000. So it is definitely designed, like most credits, to benefit those that are of a lower income. A taxpayer can claim this credit if they claim the person as a dependent on their taxes. They cannot use the dependent to claim the child tax credit or additional child tax credit. And the dependent is a U.S. citizen, national, or resident alien. Okay? Because one of the things that they must have is either a social security or an individual tax identification number, which you will often hear called an ITIN, ITIN. Okay. Now, for the other dependent credits, a taxpayer can claim their parents. If you provide the majority of the support for your parent, you can claim them as an other dependent. With most dependents, they have to live with you, but with your parents, they can live in their own home or in another situation. And if you care for them, then you can still claim them. If your parents are in, I want to say safely, Mexico and Canada, you can also still claim them if you are sending money to provide their support. Dependents living with the taxpayer who aren't related to the taxpayer can also be claimed if the taxpayer is providing predominant support. So if for some reason a friend had a situation and you had their children and you had them for over 6 months of the year and they lived with you and you supported them legitimately, you can claim them as other dependents. Your brother, your sister, who may have fallen on hard luck, lives in the house with you, has no job, is not filing any taxes. You are their primary form of support, they would go in this situation as an other dependent. Another reason why it is beneficial to you to claim if you're taking care of them and they live in your house and they don't have a job and you are legitimately their form of support, to list them as a dependent. Okay. Now, when you speak to your tax professional, or if I'm your tax professional, when we sit down to do our intake, we're going to discuss this. We're going to lay it all out, and we're going to um, make sense of what makes sense and put away what doesn't. But they will be able to give you more detail on this credit. Okay. So we're going to hop over and we're going to look at child tax credit. Now, for 2021, the filing year of 2022, because of the different acts that were put into place, American Rescue and different things like that, there was a huge difference in how things went. So it was a higher age bracket, it was a higher amount, and it was made refundable, right? Child tax credit, they even had advanced child tax credit, and it moved up from $2,000 to $3,000 or $3,600, and all was good. But for the year 2022, tax year that we're going into for 2023, it is back to normal. It is back to normal. There is no advanced child tax credit. The child tax credit is back to being non refundable. So in the past, it's always been non refundable. It is just a amount that can lower your taxable income. In 2021, it was allowed to be refundable, and you got the full amount in your refund, or in advance for half and the rest in the refund. For 2022, the year that we will be filing when we go into January of 2023, it is back to not being refundable, and it has gone back down to the normal amount of 2000. And for the most part, everything is reverting back. So now the MAC is it's children under 17. So before you go to get your taxes done, already know that this is the situation. Don't be mad at your preparer. It is not their call. That is just how the cookie crumbles. So your refund may be significantly less than it was for the 2021 tax year. I just want to make sure that this is known in advance, because education helps us to move appropriately into different things. So remember, you can take the child tax credit and the additional child tax credit based on income and other circumstances. As we get into that process, whoever you are working with, I'm quite sure will educate you. But just so you know now, here in September, before we get to January and the rush begins, it has reverted back to post pandemic. It is not refundable, and it is back to the lower amount and back to the under 17. Earned income tax credit. Earned income tax credit for the tax year of 2021, um, it had some changes also. They lowered the age to 18 or 19. the age does go back to 25 for 2022. So that has reverted back also. 17 and under for earned income credit, 25 and up for earned income credit. Okay, just to ensure that this is clear, it has gone back. So, what is the purpose of earned income tax credit? Earned income tax credit is to help those of low to moderate income to have a tax break and to bring in, um, recoup some of the money that they have spent. What is one of the maxes? Three children. You're going to claim 3 children on it. Okay. If you file married filing separate, earned income tax credit is not an option that is available to you. If you have had a situation in the past where you have claimed someone else's kids or someone else has claimed your kids or something janky has happened and you have had your ability to claim earned income credit taken away during the process, you can put in an application to have it restored. But always make sure to tell your tax professional if that is the situation, rather than just have them do the taxes, send it through, quote you a refund that turns out to not be what they said it was because you did not be forthright with the information. Of course, it has its income maxes for earned income credit. There is a table that's available to show with this many kids at this amount, this amount, this amount, what it would actually be. It is very important to keep in mind that earned income credit is a help when you're low income. But when you reach a certain amount, when you get to a certain amount, that changes. The more you make, the less you get, and eventually it goes away. So, just a quick look. If you're filing single, head of household, or widowed, and you have 0 children, your max income um, is 16,480. If you have 1 child, your max income is 43,492. 2 children, 49,399. 3 children, 53,057. Maximum credit amounts with no children is 560, so you're going to get 560 or less. 1 child, 3,733. So that's the max for 1 child. The higher your income, the lower that goes. The lower the income, the lower that goes. So this is at what will be considered the impact point with income. At these maxes, you're probably looking at the lowest point for earned income credit. With 2 children, your max is 6,164. Of course, income up, lower, income down, lower. With 3 or more qualifying children, you max out at $6,935. So you see these amounts. I'm on the irs.gov. I'm on the table that they're reflecting for this year. So this is what we are looking at for this year. So when you go and to get your taxes done, and you may have other credits that increase this or other things that go on that lower this. Just keep in mind that just because you see this on a flyer or on a sign, that this 90% of the time is not going to be the exact amount that you're getting. There's too many variables, but this is not. This is just the maximum amount. Okay. So I just wanted to take a moment and bring that um, to everyone's attention and to encourage those, because we had a lot of people that normally got earned income credit, and because of the pandemic, they got so many hours at work till they made so much till it wasn't what it normally was for them. It was either lower or not there at all. That is a good thing. Increasing your stability, improving your income is an amazing thing. It's called growth, and growth is good. So the goal is to grow off of earned income credit, to grow off of qualifying for food stamps, to grow off of qualifying for low income housing, qualifying for cash aid, grow off of these things. Like a tree, you start out as seeds, then they grow into a sapling, and as a sapling, the tree is still a little weak. It needs a little help. Sometimes you see when people get new trees planted, they have sticks with cords that hold the tree straight while the tree grows and becomes stronger. So, earned income credit, food stamps, low income housing, things like that were designed kind of like those sticks to hold you up while you grow and build strength. Well, after you grow and build some strength, you outgrow these things, and these things are now passed down to the next new tree. So, earned income credit also is based on earned income, not disability, not unemployment, not anything like that, because those are incomes that were not earned. Earned income, business revenue, work revenue. I hope that helps someone today. Again, I am Precious Swain Peaks, owner of Anointed for Prosperity Bookkeeping and More. I can be found on Instagram at precious_Swain. Of course, I'm on Facebook, Twitter, and everything else. You can shoot me a message if you have any questions, or definitely go to www.anointedforprosperity.com and book a free consultation. Have an amazing rest of your day.